So you guys have asked about my opinion on Carvana, another one of those beaten down stocks, down over 46% in just 1 year, 46% year to date. Massive, massive down move for the company. The company, as you may know, it's the leader in the online, used car sales. You could, buy a used car on Carvana, they deliver it to your house, or you could go to, their headquarters and stuff and try it out. They have like a car vending machine. And this is where this industry seems to be moving forward in the future more online. Now, in this video, we're going to take a look at the fundamentals of Carvana, see if after this 46% down year to date, if the stock makes sense right now, or if we should maybe wait for a better price. Now, looking at the income statements, there's a lot of things that I don't personally like. If you follow my mouse here, and if we look at the net sales and operating revenues, they actually went up pretty amazingly from 2019 to 2021. It's pretty amazing revenue growth because it's in a high growth industry. But if we look at the cost of sales here, the cost of sales are rising up dramatically. And as you can see, the spread is very low, which indicates to me that this is not a very high margin business. There's not high margin in this business. But what I really didn't like at all is the sales, general, and administrative expenses. They're mostly sales and marketing and all that kind of stuff. Look how much it went. It doubled. So it doubled for them to kind of double their revenues. They had to double their sales and marketing expense. And that to me kind of indicates that there is a lot of competition in the space. Yes, Carvana is here, but there's CarMax, there's Vroom, there's Shift, there's many other places in this industry, and there's no moat whatsoever. For example, let's assume somebody found a nice car, for example, in Carvana, and then they found the same car but cheaper at Shift, for example. Do you think they're gonna go and then buy something more expensive just because it's from Carvana? No, they're gonna go to Shift. So there's no kind of customer loyalty. Whatever the price is best, this is where they're gonna go. And the only way for them to attract new customers is with massive ad spending and with them cutting their margin. So I really didn't like this sales and administrative, being so high and increasing so much. But there's actually some good news with that in terms of Carvana. If we look at their sales SG&A margin, it's actually has been going down. And was in 2016, it was like 30%. And once they attracted more customers, it went from 30% and now it's only 15%. So this is a good sign. They are working to improve this margin. So it's getting better, but it's still pretty high for me, and I don't think it's gonna go down in the future. And of course, the company is, burning money. It lost another net loss of 287 million. The loss got a little bit better from 2020, but it's still a massive loss. And of course, those losses did not kind of just come for free like that. Look at their long-term debt. Long-term debt is massive. In 2020, it was 657 million. Now it's sitting at $3 billion, $3 billion of debt. So even if Carvana eventually becomes profitable and all that kind of stuff, it's gonna have a lot of debt to deal with. And it's not only taking on a lot of debt, but it's destroying shareholder value. If we go at the weighted average, diluted shares outstanding, look how much they went up. They were 30 million shares outstanding in 2018, and now it's 82 million shares. So if you bought the stock and the price stayed the same, you got diluted by more than 50%. So they are destroying shareholder value. They're taking on massive amounts of debt. And if we just look at this stuff, we likely can see that Carvana is not a buy. But let's look at the valuation. If the price is right and if there's a lot of upside with Carvana, then maybe those kind of things kind of offset all this kind of bad things that we saw with Carvana. So if we take a look at the multiple for Carvana, now for the multiple, I actually use enterprise value to gross profit because the company doesn't make any money yet. So I compared it to CarMax and Vroom. And if we look on the valuation, Carvana is trading at like 9.5, a little bit higher than CarMax at 8.6. And we have Vroom, which is the lowest of the bunch. It's sitting around 2.14. But nonetheless, the Carvana valuation did come down a lot. It was trading as high as 31 times enterprise value to gross profit. Now we're gonna take a look at my valuation model on Carvana, and for my gross numbers, I looked at the analyst estimate. They expect between 25 to 30% till 2026, and I think this is pretty fair, and this is what I used in my numbers. Okay, so this is my valuation model on Carvana. Now they make around 12.8 billion, and they're gonna grow, I estimated the low of 25% for the next 5 years, which I think you guys can agree with me on this. Now the total revenue would be around 39.1 billion in 2026. Net income margin, I put it only 3%. Why did I put it 3%? Because a more established player like CarMax, which they are much more efficient than Carvana, they've been in business for all these years and their net income margin is only 3%. Now, yes, Carvana in the future, they may be able to get, a higher margins than CarMax because they are more online and stuff. But this is not going to be before 10 to 15 years out. Carvana still has to spend a lot of money on sales and marketing for them to take market share because there's so much competition. So I think 3% is pretty fair for 2026. Now, if we use that, we get around 1.1 billion of net income. I put a PE ratio of 20. Why? Because CarMax is trading at a 14 PE ratio. It is growing 5 to 10%. Now, after 2026, Carvana is not going to keep growing 25% forever. It's going to grow between 10 to 15%. So I think a 20 PE is fair. Okay, now if I use this 20 PE, we get around 80% on the upside over the next 5 years. Now, if you want to even use a higher PE, I know some of you are going to judge me like 20 PE is too low, this is a growth company or whatever. I don't think it's low. But if you want to use a 30 PE and you want to be more aggressive, this is 171% on the upside over the next 5 years. So yes, you do get a lot of upside if you buy Carvana, but for me this is not enough for all the risks with Carvana. You have the competition risk, and even if they become profitable, they're not going to be able to use any of that profit because they're going to have so much debt by 2026 if they continue on this path. So for me, Carvana right now is not a buy. I would take back a look at it if it falls under 70, 65. It could have something, but it's way overpriced for a first mover type of advantage. First movers don't survive forever. They do have an edge, yes, but whenever they have a lot of competition trying to get market share from them, they're going to have to spend a lot on advertising, which is what Carvana is exactly doing. And as I said, if somebody found a cheaper car on the dealership next door, they're not going to go to Carvana. They're going to choose what's cheaper, and especially with inflation right now. So all this ad spending for me is basically useless. So I don't really like the stock. If it falls under 70, 65, it would be a little bit more interesting. Again, thank you so much for watching this video, and make sure you do your own research before buying the stock. If you liked it, please press like and maybe consider subscribing. So I hope to see you in another one.